Okay, so where are we? So we're just finishing up the last couple of things I wanted to talk about redistribution programs and transfer programs, and then I'm going to talk about tax. Okay. All right. So did I talk about cash versus? Did I talk about the conceptual supply shocks and demand shocks and like all that stuff? Okay, great. But I didn't show you the results. Is that right? That's where. Okay, right. So just to remind you, so yeah, I think this is what we went through last time, right? So the point about these cash versus in-kind programs is, one thing you might think about is that a cash program is going to be a demand shock, whereas an in-kind program may also be a supply shock, right? So this is like very basic, right? If you're all, what happens if we do the you can actually you can do it in different ways. It's simplest is just to draw it probably, right? Which is we have so this is the supply of whatever the good is. This is the demand of the good. If I give you cash, right, I'm holding the supply of the good. If I give you a cash transfer, right, that's going to increase the demand. If I give an in-kind transfer, then the government may not only increase the demand, but also may change the total aggregate supply. And so there may be differences in terms of the price effects from these two different programs. Yeah, Ahmed.
Well, this is assuming that if I'm giving in-kind transfer, that some say the in-kind transfer is like rice. That government has this whole stock of rice and it just sends it to different provinces or regions. But it can also very well be that government just buys from the supermarket in that region.
Totally, yes, exactly. And so you're totally right. Like if you think about rice, it's actually not obvious. Like where is it? Like if you think about housing, like government. So this example works really well if it's like if you think about say public housing, right? Where in public housing, like the government goes and like builds like houses, right? As opposed to just providing vouchers, like that's clearly like a supply shock, right? I agree with you for something like rice, it's a little more complicated and depends on kind of where's the government sourcing this rice. Like the cleanest example is if they source it outside the country and bring it in, obviously a supply shock, right? I think in some cases, if they're sort of just going into the super local market and buying it right there, not a supply shock. And so actually that's related to kind of what they're going to do in this paper. So they're going to talk about, they cut this basically by the remoteness of the regions. And the idea is that basically it's kind of related. So the basic idea is in really remote locations, what the government is doing is it probably is a net supply shock. It's sourcing the stuff externally, bringing it into the kind of remote regions. In less remote regions, some combination of markets are more elastic because they are just, they're thicker markets. So maybe the supply curve is more elastic, right? If the supply curve is if the supply curve obviously is totally elastic, then this doesn't matter, right? So in those less remote regions, it could be that, or it could just be that you're kind of like buying in those regions and sort of sourcing anyway. So for those two reasons, I think they focus on these more remote locations. That's a really good point. And just what's the point of this? The point is that if they look at sort of the price of the goods, they find a substantial increase, a substantial change in the price, where the price is And by the way, this is relative to a control. Neither of these is significant, but the difference between them is statistically significant. So they find that sort of prices are lower in the in-kind areas relative to the cash areas in the remote locations, and then that can affect kind of consumption and people's sort of overall well-being from the program because you get less. You get in real kind of quantity terms, you get more in the in-kind areas because of these price effects, and that's basically what they sort of argue. So the in-kind areas, people's total consumption is actually higher for that reason. So let me actually not go through the details of this, but are there any? Because it's a pretty simple point, but I just want to say if there are any. Just mention that those two things, which sort of seem like they should be equivalent in principle, actually have these kind of different reasons for sort of basic price theory reasons. Yeah, Tushara.
How do we think about programs where government buys, say, rice at a high price from the producers, but essentially gives it out for free to the consumers?
Wait, what's that?
So government is buying, say, rice from the producers at a minimum support price, which could be higher than the market price, and then sells it to the consumers essentially for a very low price or for free.
Yeah, it's still that's still going to have a that's still going to have a it's still going to look like this in the oh sorry no that's a different program, sorry. So you're saying there's another program. I think you're saying so this would be the market level, and we're sort of saying the government basically comes in and goes like this, right? I think you think of it like if you think of it like that, so what's going to happen? So it's going to raise the price that sort of producers are selling it at. It's going to lower the price people are consuming it at, and it's going to inefficiently increase the amount of the good, or it's going to increase the amount of the good consumed above and beyond sort of a market level. And so the way you should think about this as like a redistribution program is, first of all, we want to think about who kind of the welfare of these people are, right? Are they rich or poor? Is that kind of like a good thing to be doing or not? Relative to who are these different people. Second thing is we should think about like, do we actually want more consumption of this good or not, right? So for example, governments often, so if we, and the third thing we want to think about is like, who are the people who are sort of induced to kind of buy more of it and sort of get the subsidy? Are they sort of the people you want to be sort of targeting? So if this is like an inferior good, this actually may not look so bad. If this is a normal good, then you're actually sort of, giving a lot of the subsidy to kind of richer people, and that may not be so efficient. And the other thing is, like, do you actually care that you're sort of, distorting sort of the overall consumption of this particular good? If this is a good you think is being, suppose you think this is a good that's being inefficiently underconsumed in the market equilibrium, like you think maybe it's people are undernourished, for example, and you want them to consume more of this in the market price, this looks great. If this is like, I don't know, gasoline or something, where maybe you think that actually there's no particular reason we think we were under-consuming gasoline, this looks terrible. So I think that's the way I would think about it. But the key difference in that policy is it's changing the marginal price, right? And that's why it has kind of, whereas these other things, those things are not changing the marginal price. And the Besley-Canberra paper works through all this stuff. With sort of a poverty, thinking about sort of heterogeneity in the population and poverty, and how do we think of all the different agents, and that's kind of a very nice framework if you want to sort of think about that and compare the inframarginal versus marginal transfers. Other questions? Okay. Oh, so the other paper I sort of wanted to mention, and again, I'm just sort of giving just a brief flavor. There's an enormous literature on, an expanding literature on sort of the design of these programs, but I just wanted to sort of mention a couple of things just to give you a sense of some things people are looking at. So how many of you have heard of conditional cash transfer programs? Many? Most of you. OK, right? Great. So these are programs that are very common now in the developing world. They condition aid on fulfilling a set of criteria the government thinks are good, like, for example, sending your kids to school or getting them sort of health shocks or whatever. You get the cash transfer to do this stuff. OK, so the government is incentivizing these additional behaviors. And there were several randomized trials that sort of showed that those did increase kind of the desired behavior or the incentivized behavior. Not surprising because it's being incentivized, but turns out to be there. And the sort of justification for that is kind of intergenerational, right? The idea is that maybe parents don't fully internalize the value of their kids' human capital acquisition, and governments can correct for this by sort of incentivizing these behaviors. What this paper was sort of the first paper that I know of to sort of, in a really rigorous way, compare what is the impact of the conditionality per se. So those programs before were sort of bundled like, where there's sort of overall randomized evaluation of the conditional cash transfer relative to nothing, but it didn't say is this conditioning thing actually like a good idea or not. And this paper is nice. It sort of examines conditional and unconditional transfers in the same context. And so how do we think about that? Well, the first thing you would think about if you sort of condition on something is, of course, it's going to change the price, right? That's good if you want to incentivize that behavior, right? But the other point, which I don't think that was, people had necessarily, it's maybe obvious ex post, but wasn't, I think, obvious until people who have written this paper, is if there are people who are really far from the margin, who are not going to sort of take up the incentivized behavior, then you cut them off from the cash transfer, right? So a rigidly enforced conditional cash transfer is not going to be providing the transfer to people who can't meet the conditions. That's kind of the whole point. And therefore, those households don't get the income effects from the transfer, and that may also be important. Okay, so how do they show this? Okay, I should say, by the way, like there's another paper which I'm not going to talk about, which is about the labeling effect of the conditional cash transfer, which just sort of says if you tell people the conditional cash transfer, it's like a conditional cash transfer, but don't actually enforce the conditions, people may kind of like think they're enforced and kind of do them anyway. And that paper sort of says like a labeled cash transfer versus an actual conditional cash transfer, you may get a lot of the benefits just from the labeling without kind of this negative kind of cost. But what do they do in any case? So what do they find in this case? So let's look at this. So what are some of the things I wanted to sort of note? So the first is let's look at actual kind of so they condition on sort of enrolling your kids at school. They have the sort of self-reported enrollment, but then they have teacher-reported enrollment, and they have some arguments in the paper that the teacher-reported enrollment is kind of the better one. So lo and behold, like not super surprising, the conditional cash treatment, which is incentivizing people to go to school, results in more kids going to school. Okay, so that's that, and you can see it kind of for 3 years, whatever. And those things are statistically significantly different in most of the specifications. And they do better on their test scores. Okay, fine. So it seems like it works in terms. The conditionality is important for the incentivized behaviors. On the other hand, they also then look at sort of early marriage basically as another outcome. So early marriage for particularly for girls in the household, and early marriage is not an incentivized outcome, but it's something that you might think that preventing early marriage might be something that the government might care about in this context, even though they're not incentivizing it. And what they find is that actually the fraction sort of who are ever married in this period is actually lower in the unconditional treatment than in the conditional treatment. So both of these treatments lower early marriage compared to the control, but it's larger in the unconditional treatment. And what they argue what's going on, you can kind of see it here, which is if you look among those who are not enrolled in school, okay, so these are the people who would be not getting these are endogenous groups, right? So there's fewer people not enrolled in school in the conditional treatment than in the unconditional treatment, right? This is the share of the group, so that's not surprising. That's the condition. That's what we just saw, right? That the sort of the unconditional treatment, the conditional treatment reduces the number of people who are enrolled in school, who are not enrolled. Sorry, but there's a big effect of the program on early marriage for the not enrolled group in the unconditional group, but not in the conditional group. And why is that? Because these people over here don't get the transfer. Okay, this cross tab here is not super clean because this is kind of an endogenous variable. There could be sample selection here. But I think that this is a pretty natural explanation but these effects are sort of well identified. And this is a pretty natural explanation for kind of what's going on over here. Right? So basically what happens is I think the way to think about it is there's a bunch of kids, right? Some of them are on the margin for going to school or not. And they, in the conditional treatment, some of them switch over here. They don't go to school. I mean, they go to school, right? But there's another set of kids who are just not on the margin for going to school or not. And for those kids, the income effect could be really important. And you're taking away the income effect for the kids who are not enrolled in the conditional treatment. And so this basically sort of analyzes this, I think, a little more, showing you sort of, basically showing you the same thing kind of in tables, actually. Maybe not, I don't need to go through that. But I think this is kind of the key insight. Yeah, Ahmed.
So when treatment is unconditional, right?
What?
When the treatment is unconditional, you are saying that it affects a larger number of people. But then does this cost more? So are we comparing? Is the treatment the same amount?
No, it's more expensive. You're right.
Then we are still
because you're right. In the conditional treatment, you don't pay the transfer. Well, I mean, it is actually there's two different effects. Number one is in practice, actually monitoring all the conditions is actually not free. So you do get a cost savings over here from not having to actually go and do all that monitoring or whatever. So that's one point. But on the other hand, you're right. You are saving, quote, saving, unquote. You're not paying the cost of those transfers for the people that are getting cut off, which is, 30% of the sample over here. So you're right. The transfers you're giving out are whatever. Here you're only giving out 70% of the cash compared to what you're giving out here. So you're right. It's probably going to try a bit cheaper in that sense. I suspect these differences are sufficiently stark that maybe that's not going to do it, but it's a fair point. Other questions? Okay, so I think that was sort of I just want to sort of mention that as sort of everyone always thinks that these conditions that the conditions are good, but it's sort of worth keeping those in mind as well. I'm not gonna. I sort of wanted to sort of just put that out there as sort of a pointer almost. Those two papers almost as a pointer to kind of a whole literature, which I don't have the sort of bandwidth here to sort of go through in detail, but understanding kind of the design as countries are doing more of these transfer schemes and redistribution schemes, understanding the design questions involved in doing that properly is kind of a really expanding area that people are thinking through. So, for example, some recent work, we have a paper on like how do you actually deliver the transfers effectively, and does transparency, and giving people information about kind of what their rights are matter. One of our recent papers says yes on this. How about technology and reducing corruption? There's a lot of interest in sort of what is the sort of underlying technological infrastructure of these programs. Smart cards, biometric authentication, digital payments, all that stuff is sort of kind of entering, and sort of understanding that has been a really active area of research in the last kind of 5 years or so. And actually, even just sort of changing the back end system, like the kind of the nitty gritty of kind of how the government design, reimburses itself for these programs can be really important. We have some papers we have some paper on kind of government versus private distribution of this. There's some work on how do you get people enrolled. There's questions about more stuff on the sort of cash versus in kind. Should you have transfers be lumpy? Should they be sort of, should they be a series of lumpy, big lump sum, or a small series of payments, et cetera, et cetera. There's sort of a number of questions that people are actually studying here. I'm actually in the middle of sort of writing a lit review on this with several co-authors. But I just wanted to mention that if you're interested in this, I think this is a really active area, but there's also sort of a lot going on, and so it's worth just sort of making sure you get up to speed if you're interested in these topics. But there's a lot of active research on this. Okay, any last questions before I switch gears? Okay. Just general. Oh, sorry, and one last thing. I think a lot of sort of lower and middle income countries, not kind of the poorest countries in the world, but kind of low middle income countries, are starting to think about social insurance programs now. Like, how do we provide health insurance, disability insurance, weather insurance, crop insurance, like those kinds of schemes. And I suspect, and there's just beginning to be some research on that, and I suspect that's kind of an important kind of next frontier of sort of how do we understand those challenges in kind of these low information and low governance kind of environments. So I think that's I just wanted to mention that as sort of an important kind of next frontier of future research. Okay, any last questions before I switch gears? No? Okay. Yeah.
How should we compare these kind of spending with like infrastructure spending?
I'm sorry, Kyle, you gotta speak up.
Sorry. How should we compare this kind of spending with, say, infrastructure spending? Like, is that possible, or do we know anything about that?
Yeah.
What's that?
So maybe in terms of marginal value of public.
Well, that's exactly what I was going to say. Yes, exactly. I was trying to sort of like say, well, yes, you can compute the MVPF of all of these things and try to sort of think them through. That's not I think that so that's what I was going to say. Yes, you just sort of figure out a welfare frame. So 2 points. The first is you need sort of an augmented. So okay, so this is for those of you who've seen kind of taken public finance. You've probably talked about the marginal value of public funds as sort of a framework for sort of just thinking about what is the marginal benefit of a dollar of government spending relative to the net cost of the government, where the net cost takes into account the effect of the spending on future government revenue. So it's sort of that's kind of the rough. Or another way of saying it is it's kind of like what is the recipient's willingness to pay for whatever you're providing relative to the net cost to the government, where the net cost takes into account effects on future government revenue. So some of this stuff actually looks free, like has infinite MVPFs if basically like net cost of the government is zero because it it increases people's future kind of earnings so much they pay more taxes and so on and so forth. In principle, those approaches allow you to compare everything to everything else. The problem is you have to actually estimate the two things. Number one, you have to estimate kind of what are the gains, or what is kind of the willingness to pay in some real sense, and what are the real costs. That's hard to do for some of these programs, particularly some of these infrastructure programs. The other point is, though, you also need to sort of augment that approach to make sure it has takes into account redistribution effects. So the baseline MVPF it considers like $1 is $1 for everybody. But if programs are fundamentally about redistribution, you got to sort of take into account the fact that giving $1 for a poor person is more valuable than $1 for a rich person because of concave utility, and you got to sort of include that kind of in the welfare calculation somehow. So the long and the short of it is yes, you can do it. What you need to do is kind of a careful kind of cost-benefit analysis or a careful marginal value of public funds. There's a bunch of inputs you need to sort of do that. But you kind of want to think of what is the net social return relative to the net social cost of the government, taking, weighted by some redistribution metric, roughly speaking. Okay, other questions? And there's a Hendren and Sprung-Kaiser paper on some of the marginal value of public funds in the QJE, I think last year, which sort of goes through some of this in a fair amount of detail of how do you think about that. I don't think it talks about the redistribution component a bit as much, but I think it's probably in there somewhere. And also, when our review paper is out, it'll also talk about that too. Other questions? Yeah, Sean.
What do VPFs tend to look like for these programs in developing countries?
I don't think it's been very well calculated for most of these programs. I think it's a great question. I don't think people have calculated for a lot of these programs. The other thing I'll also say is that, yeah, let me just leave it at that. But yeah, there's a lot of interest in so there's starting to be some long-run evaluations of some of these programs, which are starting to sort of say what happens to these programs, to people 10, 20 years later, to sort of see, are they entering the workforce? Can we actually sort of, because one of the questions is sort of what is the long-run impacts on people's kind of ability to work and ultimately pay taxes and kind of all that stuff, and are they in the tax net? And I don't think that stuff has actually sort of been fully thought through, frankly. I think there's a lot of interesting issues in doing so. Often, for example, when I've seen some analysis like this, they'll say, well, we're going to look at some interim impact. Like they'll maybe do it with 2 stages. They'll say, well, there's an impact of this in going to school, and then we'll take the schooling regression and sort of apply it to that, and so we'll back something out, kind of that. So that's kind of some of the approaches people take. But I think that sort of thinking about some of this stuff kind of seriously would be interesting, and maybe more work to be done there. Other questions? Okay. So the flip side, the next part of this is, well, how do we raise money to pay for all of this, and how do we think about kind of the challenges of the public sector in kind of a developing country context? Okay, and there are, broadly speaking, so what am I going to talk about? I'm going to talk about a bunch of things. First is I'm going to talk about what's different about sort of the public sector, the tax side of things in a developing country context. And I'll talk about a couple different theories for what's going on there. I'll then talk about, I think, 2 different ways of approaching the problem of tax enforcement. So one of them, and this is related to the paper you guys read for today about the VAT, essentially you can think of that as through the tax structure. Are certain kinds of taxes or tax structures going to work better in kind of these low information environments? And the second is tax administration. Are there certain things we need to do about the way we collect taxes that are going to be sort of different in kind of these developing country contexts? And ultimately, sort of, does this matter? And then I also want to talk briefly, if I have time, about something called informal taxation and sort of which is I think the analog to informal insurance on sort of the tax side. Okay, so that's kind of the outline. All right, so just stepping way back, if you take a public finance class, there's a vast literature on taxation issues. Incidence, optimal income tax theory, capital taxation, subtractions, and considerations, and so on and so forth. You can take an entire semester on this stuff. I think, by comparison, understanding kind of how do we think about this stuff in a developing country context we know relatively little. We know a lot more than we did maybe even 10 years ago when I first started teaching this class, which is exciting. And this has actually been a really active area of research, which is kind of part of the reason I sort of want to mention it for people who are interested in development economics questions. The other thing is, I think what we know suggests that there's something that is kind of very much a development economics kind of issue, thinking about some in the tax structure. And I think there's two. The first is, and these are the same themes that I think came up in the stuff I talked about redistribution. So one issue is an information problem, right? In the same way we had information challenges of identifying who's poor, we also have information problems of figuring out how to tax and how much to tax people, right? So how do you levy an income tax on subsistence farmers, for example? Like, or even do you want to do that? How do you tax labor in a place where you have a 50% of the economy is kind of in the informal sector? Like, how do you? The government just has much less information about a lot of people, and so how do you deal with that? And the second is, I think, on enforcement or kind of governance, which is, I think also related to the information problems. There's a lot of opportunity for corruption and sort of other problems, and how do we think about the kind of enforcement side? And I think that suggests that sort of the way we may want to think about taxation in a developing country context may not just be, we should think about, what is the optimal Ramsey tax and how do we sort of, set our taxes. I think that some of those issues are perhaps important, but some of these other issues may be kind of really first order. And that's kind of what I want to sort of talk about today. Okay. Yeah.
A quick conceptual question, like how much of these issues are limited to the public sector, and like what you describe like public sector trying to roll out benefits and public sector trying to collect taxes, like the same issues are true of any private company trying to source inputs or figure out which customer is good or something like that. Like, does that make sense?
Yeah, so I think it's a good question. So I think let me hold that thought for a minute. I actually think that there are particular issues vis-a-vis tax. I think they are a bit different. So let me give you some examples, and then you can see what you think. Well, so in particular, like one of the big themes actually is about third-party reporting, which is sort of about formality, and that's like has a very specific kind of tax structure. So what was your follow-up question?
Yeah, I guess like are there any particular constraints in government space when doing such things that private firms will not? I guess
I mean, in general, it's the opposite. In general, governments have a lot better options than private firms, right? Like if you think about what can the IRS observe about you, they know a lot more than Amazon.com. Maybe they don't actually, in this day and age. But in principle, they can observe all kinds of things that the private sector can't, because they can mandate that people report stuff to them, right? So that mandatory reporting of information and means that they can. Now, it's kind of interesting. As I said, maybe in the new tech world, they can figure out ways of backing a lot of this stuff out, by what you click on or whatever. But the government has a fundamental advantage, which is it can make you tell them stuff, and they can throw you in jail if you don't, or if you lie about it. So like that is a huge advantage the government has over the private sector in getting information. Right? Okay. It can make you tell them stuff. It can make banks tell them stuff. It can. I mean, although again, how that's actually a policy question is sort of how much of that additional reporting we want, and different countries, make different choices about how much information they want the tax authority to have. And actually, this is actually, if you've been reading the news in the U.S., for example, this question about sort of like should the IRS be able to access information about your bank balances and under what circumstances is actually an active question of policy debate where people seem to actually disagree about this question, apparently. So okay. So anyway, so I think it is different. Okay. So just a few overview facts. So this paper by Gordon and Lee was kind of basically made the point that just overall, this paper's a bit out of date now, but overall the tax structure looks very different in kind of developing countries than it looks in developed countries. So there's just a few facts here. Actually, let me pass out the handout. Oh, I want one. Thanks. Okay. So this is too small to read on the screen. Maybe I can zoom in a little bit. Okay. So what's the point? Several just facts. First is rich countries have a lot more tax revenue as a share of GDP than poor countries. Okay, so in general, the size of the public sector looks really different. Number two, where they're getting their tax looks really different. So income taxes, in general, are a smaller share of revenue in rich countries than in poor countries. Corporate income tax is a much larger share of income taxes in poor countries relative to rich countries. So like in the very poorest countries, half their income tax comes from corporate income taxes. In rich countries, it's like a sixth or something. So rich countries are better taxing individuals relative to corporations. Poor countries tax corporations. At least in this period, tariffs are like a non-trivial share of government revenue. This, by the way, was true in the historical U.S., for example, also. That tariffs used to be a much bigger deal than they are. So tariffs are non-trivial. They also talk about seigniorage as a function of revenue. Again, I'm not sure. Inflation has gone down up until like the last 6 months. Inflation had gone down a lot, I think, around the world. So this may be a little bit out of date. But inflation was more of a big deal. And seigniorage income, which is sort of the revenue the government gets from printing money, was a non-trivial share of the government budget in some of these countries. And the other fact is the informal sector as a share of GDP are much larger. So it looks like these countries are kind of doing different stuff, and a question is kind of why. And so there's two kind of theories that here are two theories that can explain kind of why things look kind of really different. So one is this theory by Gordon and Lee, and the other is a theory by Clavin, Kreiner, and Saez. So this one is about the financial sector generating information. So one, which I'll talk about in a second, and the other one is about third-party reporting generating information. And the underlying both of them is this question of like, the government needs information to tax you, otherwise you evade. And where do you get the information? And why might that look different in sort of these two different contexts? Okay, so I'm going to talk about this one very quickly. And this one I'll go through like a super simple model to make the point. Okay. So the Gordon and Lee paper argues that the financial sector is really important. And the basic idea is that if you use the banks, the banks observe how much money is flowing through your accounts, because that's just what banks do, right? They have to keep track of kind of how much money you have, so that creates like a record of kind of what you're doing. And the government can sort of tap into that record and use that as information to sort of tax you, okay? And they kind of just argue basically that essentially larger organizations need to use the financial sector. So sorry, you can do it in a couple ways. Number one, there's more financial development for other reasons in rich countries, just like people are using banks for kind of other reasons. And number two, even within the corporate sector, really you can run a local pizza shop maybe in cash, but you can't run General Electric in cash because it's just too complicated. Right, and you need to actually, use banks. And there's another fact, which we'll talk about in 14772, that kind of like firms are just a lot bigger in kind of developed countries for sort of other sets of reasons. So, little tiny mom and pop shops that maybe potentially could run in cash are a much larger share of kind of what's happening kind of in the corporate world in like India than they are in the US, for example. And so, that also gives you, they argue that basic fact of kind of like the financial sector generating information generates a lot more of the pattern, some of these patterns. So for example, they're going to say that's one of the reasons why developing countries are going to spend a lot of their effort taxing corporations, because at least they can see the corporations and see what they're doing, right? If sort of large corporations are sort of inelastic in kind of their use of the formal sector. And then they sort of argue everything else has to sort of like do that, which is now, so for example, we have this sector that's now being taxed a lot, which is the sort of the informal sector. They start arguing maybe you have to have tariffs to kind of protect them and sort of make sure everyone's on a level playing field. And then you use inflation, they sort of argue maybe as an optimal tax on the cash economy. Okay, because so basically, if putting your money in the bank means it gets taxed, we also kind of want to have an equivalent tax on your cash holdings, since they do that through inflation. This maybe is like a little like too neat, maybe. Like it's not totally obvious to me that like in fact actually what's really happening in these countries is the central banker is saying like actually the optimal Taylor rule level of inflation in our economy is 10% because we want to sort of correct this tax wedge between. So I'm not. This story is I think consistent. I'm not 100% sure it's how people are actually thinking, but that's sort of a story. So their argument is sort of it all flows from this financial sector, and kind of everything else in this tax structure kind of flows from that. I'm not going to go through that in a lot of detail, but I sort of wanted to mention that as kind of one argument. The second argument is this argument that sort of Clevin, Kreiner, and Sayas have put forward, and this comes to is related to a series of papers that they and others have done on this idea of third-party reporting. And this is consistent with the VAT paper that you guys read for today. So the basic kind of idea of a lot of taxation is how does the government know stuff? Well, it gets information from two different parties and compares, and if it gives you you get different answers, you think there's something funky going on. And what's called third-party reporting of the same information. So like the government is, say, the first party, I'm the second party, I report to the government. Having someone else report that same information makes it harder for me to lie. Okay, so here's a sort of a simple model that sort of can explain like why is this kind of relevant and like why is this potentially kind of a development phenomenon. So most taxes, they argue, are collected through third-party firms, third parties such as employers, which double report. So for example, I work for MIT, right? And every year at the end of the year, like I tell the IRS how much I think I earned, and MIT tells the IRS how much they paid me, and the IRS can just check if I'm reporting something different than what MIT reported. That's like a red flag, and I get audited. Or they just send me a correction letter saying, they would send me a correction letter saying like you've underreported your taxes, please pay. Okay. And there's some work even in modern economies. These same sets of co-authors have, or some combination of them, have a nice paper in Denmark, for example, showing that underreporting of income is very, very low when it's third-party reported, and very high even in Denmark when it's not third-party reported. Okay, and so and I think that's probably true in lots of places, right? So this may be for So and the idea of this paper is that to argue that this third-party reporting, it's easier to sort of make this thing work in kind of really large firms. And then they're going to sort of rely on the fact I just told you, which is that sort of firms are much larger in kind of the developed world than in the developing world. So what's the argument? Okay, so imagine there's a firm with n employees, generates some surplus, big W, and some wages, W1, Wn, and the total wage bill is just the sum of the wages. Third-party reporting is that the firm and the employees report W bar to the government, and the government taxes you based on W bar. And imagine if W is not the government, the firm has to keep track of what it's doing, so it has a set of books, right? And people inside the firm know what W is and they know what W bar is, and if those are different, that people sort of understand that, right? So, and in particular, if W is less than W bar, any employee can like go to the IRS and report that you're cheating. Okay? And if someone denounces you, the government applies a fine theta for all the evaded taxes plus collects the back taxes. So basically, if you get denounced, you pay 1 plus theta times the amount times W minus W bar. Okay? So if everybody can agree not to denounce you, then we all just report W bar equals 0 to the government, and there's some surplus, and we split the surplus. Okay? The problem is that a single employee can denounce the cheating. Okay? And this can happen for two reasons. There can be random shocks, which is either someone makes a mistake, or someone gets annoyed or aggravated, or you can actually have rational whistleblowing. Okay? And both of these are going to make it harder to have misreporting in larger firms. Okay, so why is that? So here's the random shock version. It's very simple. So if W is not equal to W bar, then imagine that each employee denounces with probability epsilon. What is epsilon? It's like I get really mad at you, and I go to the IRS and turn you in. And actually, if you talk to the IRS, how do they learn stuff? It's really a lot of cases like that. Like some employer has some disagreement with the employee gets really aggravated, and it's like, well, I'm gonna show you, and marches into the IRS office and tells you and denounces the firm. Okay, so I think this idea that sort of people get upset with some probability and go denounce the firm is actually kind of a pretty reasonable summary of what happened. So actually, in fact, we had a student a couple years ago who was looking at not tax, but a related thing of kind of Medicare and Medicaid fraud in the US and talked to a bunch of prosecutors, and they were like, yes, this is exactly how we learn about stuff. It's like some disgruntled employee walks in and is like, I'm going to tell you what's actually going on. And they're like, please do. And okay. What's going to happen? Well, this is almost obvious. We say it, right? What's the probability the firm's going to get away with it is 1 minus epsilon to the nth power, okay? Where n is the number of employees you have, right? So everything basically follows from that, right? So what is the probability that you get away with it? Essentially, is going to be declining with that. So at some point, it's going to basically be not worth it for you to do that. And in particular, they give this condition that they're going to evade if 1 minus epsilon to the nth is greater than theta over 1 plus theta. You can work this out yourself. I don't think it's crucial. This is the key point, right? The more employees you have, the more likely it is someone's going to get aggravated and denounce you to the government, and therefore really small firms can probably sustain this with high probability, and therefore it's worth it. For really large firms, the probability you get denounced is really high, and because the penalty is applied to kind of all, and the key thing driving this model is, it only takes one person to denounce, but once I denounce, I catch everybody, and you pay the big penalty. So the penalty kind of is the penalty per person is constant, but the sort of the probability is increasing with it. Okay, so that's that model. The other model, I didn't actually put it up. The other model is actually, I think, even a little more interesting, actually, which is this whistleblower idea. And the whistleblower idea is, and this actually, the US actually does exactly, it's actually one of the few countries I know that does exactly this. So the US's whistleblower policy is, if you walk into the IRS and you say, MIT has been cheating on its taxes, and here's how, they pay you, the whistleblower, between 15 to 30% of what they recover. Okay? So why is that a great policy? Because now what happens as the firm gets large, right? Any individual employee can walk into the IRS and take the whole 30%, right? So for a firm of size 2, for example, right, this is not worth it, right? Because you're only getting, say, 30%, but you were getting half the surplus, so 30% is less than half the surplus, so you're worth off. For a firm of size 10,000, this is like a really awesome deal, right? And therefore, in equilibrium, people they don't actually have to pay very much in equilibrium because nobody cheats, right? So in equilibrium, this is like free, but prevents cheating in kind of large firms. So I think this kind of idea of these of these whistleblower rewards, actually, I think this one I think is more the developing country version, because I haven't seen a lot of developing countries do this whistleblower thing. But the same argument, I think, also could be there. But in any case, both of these sort of have the principle that sort of as the economy grows, the optimal firm size is going to increase, and therefore you're going to end up in these really large firms. And in the really large firms, it's just too risky to cheat because someone will probably denounce you. Okay, and I think there's something to that. Yeah.
Is it actually the case that if the firm grows, the individuals who actually have information about the taxes, or tax within the firm, also grows proportionally to the firm?
Yeah, it's a good question. So you're right. So in this model, everybody can denounce. You might think as the firm grows, we have a specialized accounting department who becomes more and more specialized, and maybe it's only like 3 accountants who actually have all the information. The problem is every individual knows they were cheating on your own taxes.
Every individual knows?
Yeah, because even in the model with an accounting department, right? You know what you actually got paid, and you know what the firm told you to write down on your taxes. So everybody knows that the firm is cheating. And that could be enough to sort of start the kind of process. You could at least walk into the IRS and say, I don't know how prevalent this is, but like, here's what they told me to do, and here's what they told my buddy to do, and like maybe that's enough. So you're right that creation of specialized knowledge may undo this, but I think the fact that the key point is everybody has to be complicit in the cheating. Okay. So this paper by Jensen, I think this is actually now forthcoming in the AER, sort of takes seriously this idea that basically individual income taxation only works in kind of formal employment relationships. So another way of saying it is that, like, so what's the idea? He says, look, if I'm an employee in a formal firm, then the firm is double reporting, right? And maybe the government can try to collect it. But if I'm in an informal firm, or if I'm kind of self-employed or whatever, like, forget it, the government has no hope. Okay? And Jensen asks, well, what are the implications of this for sort of the tax structure more broadly? Okay? And in particular, he basically postulates that countries kind of realize that when the employment share, so it's like, what are the implications of this for how we design the tax code? Okay? And he argues that basically when the employment share in a given income decile is too low, governments basically just give up on taxing those people altogether and just make them exempt from income tax. They don't even try. Okay? And then he basically argued that as countries develop, as countries become sort of larger, the share of people who are kind of working as employees in those larger firms, that kind of increases, and that moves down kind of the income percentiles, and therefore countries are going to change their tax structure sort of endogenously. Okay? So I'm going to focus just on some cross-country facts for now, which I think are kind of cool. These are first the U.S. overtime. So what is this? Okay? So this is the employee share, okay, over the employee share by income decile. Okay, so this says what fraction of people are like employees, like in part of a firm, or self-employed. The informal sector we're not going to really focus on here. But so what do you see? So in the 1870s, it looks like basically, almost most of the people in the United States, in most income deciles, it was only kind of the employee share kind of only happens kind of at the very top of the income distribution. And we have no income tax in 1870. So the U.S. income tax was introduced in 1918, 1919, I don't remember exactly, approximately in 1918, plus or minus a couple years. 1912, does anyone remember? It's in the 1910s. There's like a constitutional amendment to allow it. Anyway, approximately then. Certainly not here, and yes here. And so this bar is where is the exemption of the income tax? People below, so almost all countries say people below some income don't pay income tax. And he says, well, where is that threshold in the sort of income distribution? And he says, and you can see that basically what's happening in the US over time is two things. As the US grows, the employee share is really changing. Okay, so it's always the case that richer people are more likely to be employees, but kind of where that thing is happening is moving kind of like down the distribution. And as that's happening, the income tax exemption threshold also is moving to the left. Okay, that's the US over time. So what do you see? So the next point is that sort of like, if you look across countries, okay, you see very similar patterns. Okay, so India, like, looks a lot more like the historical US, right? Only kind of employee share is kind of really high, very high income tax threshold. Indonesia, a bit richer in his data, sort of, it's a bit to the left of the threshold, and again, this pattern is sort of similar. If I were to show you Mexico, it's what you expect. It's going to kind of look like a little more to the left on both the black line and kind of those crosses and so on and so forth. And I think that, and then you can sort of plot kind of all these different countries, and you can see a couple things. The first is, what is the sort of overall employee share? What fraction of people are employees versus self-employed? you can see that this general pattern we were seeing, that sort of this is moving to the left and sort of getting higher as countries become richer, that seems to be true looking kind of a cross-section of countries around the world. Okay, so richer countries have high employee shares, poorer countries have much lower employee shares. Okay. You also see that sort of the personal income tax base is kind of what share of the population is above that black line, sort of required to pay kind of personal income taxes. That's also kind of declining with income. So richer countries are trying to tax kind of further down the distribution. And this says what fraction, this is the kind of the most amazing graph of this paper. This is what fraction of the total employees are in the personal income tax base. So it's kind of like the ratio of those two things, right? What fraction of the people who are employees are above the black line is almost constant as a fraction of development. Okay, so this is basically arguing that sort of as countries are, what's kind of happening is countries are sort of realizing that they can only tax people who are employees, and sort of they wait until sort of, and they're sort of designing their tax schedule to take into account the fact that basically, it's only kind of worth it to kind of go after the employees, and they're sort of doing that at almost a constant, not exactly constant. It's still the case that it's a little bit higher, but I think this is like remarkably flat by comparison.
I have a question.
What?
I have a question. Does that, what happens with the informal employees?
This is only formal employees.
Okay.
Should only be formal employees. I believe it's only formal employees. I'm not 100% sure how to calculate in the data, but it should only be formal employees. The model is only about formal employees. I don't remember the details of how he constructs this from all the different data sets to know if it's formal or informal employees always, but it certainly should be based on the model. Yeah.
Follow up. What if informality is indulgence? So, coming off Sal's question, I imagine maybe that ratio is the same for India and the U.S., but I'm thinking in India, there are some factories that can hire the same employee and just choose to have them be formally on the books in Social Security, or just have them pay them cash and have them do the exact same job. So it's they might still be salaried in some sense, but it's still be employees.
Yeah. So let me apologize that I don't remember exactly how he's constructing this data to answer Sal's question. So I don't remember that question well enough, and I should. But I think the point is an equilibrium relationship. Okay. I think that's the way I would think about this graph. I guess the broader point I'm trying to argue. So I think this is I think a very and there's another part of this sort of looking in the U.S. But I think to me what I think is really pretty remarkable about this is sort of showing that at least it looks like the data is certainly very consistent with countries sort of choosing their threshold of kind of who we're even trying to tax, taking into account what's going on in the employment structure. I agree with you that there's a whole range of additional questions to think about, formal versus informal, and so on and so forth. So I don't think this is by any means the last word on this, but I just think the point I want to illustrate is that the idea is that kind of thinking about sort of the previous model, the countries sort of, the data is consistent with the idea that countries realize you can only sort of tax people who are in kind of these employment relationships in equilibrium and, are adjusting their tax code implicitly, and therefore as countries develop, sort of more, one thing that naturally happens is, because kind of they work in more larger companies and those kind of that happens as part of the development process, that also has implications for sort of what's going on the tax side. Questions? Okay. I think one question that this may raise is, can you improve on the ability of firms to report on their workers? So this sort of, can we sort of this whole thing was sort of taking it as kind of exogenous epsilon thing, but can we change this, right? Can we change the probability, can we change, so can firms change epsilon, sort of the probability of sort of getting a report? Can governments change epsilon, the probability of getting a report? And I just want to mention kind of one paper here, which I think is a really nice paper that tries to look at this. I think this paper doesn't sort of, it has some sort of data limitations, so I don't think totally is the last word on this subject. So I think I just want to mention this as kind of, I think, an exciting, interesting question to think about. So what does this paper do? So this paper says, look, under Mexico's kind of old pension system, workers' pensions were essentially a flat function of how much your wages were reported. sorry, they were flat function of how much your wages were. They were not a function of how much your wages reported. They were a function of like years of work. So you didn't care what the government was reporting on your behalf. In the new system, it's you basically essentially get some fraction put into your pension account as a fraction of kind of how much the government is reporting of your income. Okay? So now all of a sudden you go from a world where you have an incentive to care about kind of what the government is telling about your income from one where you don't. And they try to sort of establish a different diff by sort of saying after the reform, maybe young workers have a greater incentive to make sure firms report wages honestly than kind of before the reform, and they find there's sort of a better match in wages before and after. The paper, as I said, like there's some empirical challenges. They don't quite, so it's a little bit tough. But I think this question of sort of, I just wanted to mention this as one example of like how do you think about improving epsilon? How do you think about changing epsilon? Actually, this was something that I actually myself tried to do tried to develop like an RCT on this topic in Indonesia. It didn't end up working out. But we're literally, and we were thinking of, well, maybe the government could just start sending people text messages and sort of say like, hey, like what's the, here's what was reported for your wages this month, FYI, as a way of sort of increasing that, like that epsilon. But I think more generally, I think this is kind of an interesting question. I just wanted the epsilon isn't fixed, and maybe you can sort of do something about that. So I just wanted to put that up there. Okay, questions? Okay, so now I wanted to talk about the paper that you guys read, actually, sorry, for last time, which is about value-added tax. And the reason I sort of want to mention this is I feel like, as I mentioned, there's two different approaches to kind of what we can do about this problem. Sorry, the first set of papers was just like, why is this kind of like look different in the developing world? The second set of papers are like, what can we possibly do about this? Number one is on the tax design side, and the other is on the tax enforcement side. So this paper on the VAT is an example of the tax structure itself, designing the tax structure itself to make sure that it's kind of third-party reported. Okay, so I think for all the non-Americans in the room know what a value-added tax is, or knew prior to reading this, because every country in the world basically has one, except for the United States, approximately. So basically, the idea is that firms are taxed on output, but receive a tax credit for what they already pay in their inputs. Okay, and the other thing you have to note is that imports are taxed and exports are not taxed. So at the very end of this, at the VAT chain, you have to rebate, and the reason is you want everything to sort of be on an equal playing field domestically. So if we were sort of taxing all domestic production at say 10%, we want to tax imports at 10%, so the imports aren't sort of cheaper than domestic stuff, so they're sort of equally taxed. And the way that sort of the world has kind of worked this out is that when things come into your border, you tax them at your local VAT rate, so you have a uniform tariff at your VAT rate. And when you export things, the exporting firm gets a rebate equal to the sort of the sum of the VAT on the input chain. So essentially, everything is taxed at its own domestic VAT rate, regardless of where it is produced. That's kind of the principle. I will note that in a lot of developing countries that I've been engaged with, this step ends up being challenging. So governments love taking money in. They do not like sending money out as a general rule. And so they put a lot, and also can be worried about a lot of fraud. So they put a lot of checks and cross-checks on sort of those VAT rebates at the export stage. And that can be sort of an important impediment to trade, actually. And so actually thinking about that question of sort of how do you make that VAT exporting step kind of work properly is, at least in some cases that I've encountered, a challenge. Okay. And so why do a value-added tax if everyone participates? This is equivalent to a consumption tax, right? So this is the idea. So the idea here, right, of our little VAT chain. Right. So I can't remember the way Dina draws it in the paper. Which way does she draw it? Okay, she goes to supplier on top, right? So we have the supplier. The chain goes down. Right. Middle and retail. Okay. So we have, so this is like, goods are moving down the chart, right? So the idea is that this person, like this is the raw supplier, pays VAT on this piece here. This person pays VAT on this minus this, so they pay VAT on this, and the retail pays at the bottom. And this is equivalent to just charging a sales tax at the very bottom, right? Both, if it's uniform, you're paying a tax on the whole production chain. It's just that here it's collected in sort of these three different pieces, whereas here it's kind of collected kind of all at the end. So, like in the U.S., for example, like you pay a sales tax when you buy things in Massachusetts, for example, of whatever 6.25%. They're taxing it down here. In a VAT, they're trying to do the same thing, tax consumption, but they're taxing it kind of all the way through the chain. And the idea of this is that basically you get better kind of reporting, because in a sales tax, like the retailer has all kinds of incentives not to sort of like to underreport the total sale price, and the government loses those taxes. That's still true here, by the way. There's nothing kind of going on over here. But in all the previous steps, you have kind of incentives that go in opposite directions. So this person would like to underreport, right, how much they are selling their good for. But this person over here would like to sort of make that number as big as possible because they get a credit for that amount, right? And so if the whole idea from kind of governments is we get accurate reporting of information if we have information reported by both parties, the whole idea of the VAT is that we can, for everything except for the very last step, we can generate double reporting of information, and the government can kind of actually like use that to kind of figure things out. Okay, so that's the basic idea, and this paper is about testing kind of whether that idea actually works, and sort of there are these kind of VAT chains. I think in your comments, I just wanted to mention a couple things. You guys mentioned that sort of one thing that actually has to happen, which you'll see as we talk about this paper, is doing this third-party reporting is actually kind of tricky. So it requires the government collecting tax ID numbers for everyone to match every transaction, or at least every firm, at the firm-to-firm level. It turns out that actually is kind of harder than you may think. And at least in some contexts that I've worked at, they collect all that data, but actually they sort of try to actually analyze it and figure out if people are actually cheating. It turns out to be a sort of very labor-intensive and surprisingly hard to automate kind of process, because the world is messy, right? It's a lot simpler if I have one employer, and the IRS can sort of pretty easily check my kind of income tax. For a complicated world where a firm has got thousands of clients and hundreds of suppliers, doing all this stuff kind of can be surprisingly tricky. So someone mentioned sort of automating kind of what is the impact of digital payments or automating stuff. I think actually understanding all that and how that kind of implies what governments can tax as kind of firms are developing and becoming kind of more, countries are developing, becoming more electronic or whatever, is kind of an interesting area to think about. Another thing, what else was I going to say? Okay. There was another thing I was going to say about this. Anyway, okay. All right. So what she talks about in the paper is that there's potentially two different kinds of tax evasion. She calls them collusive evasion and unilateral evasion. So collusive evasion is we omit an entire transaction completely, whereas unilateral evasion is we kind of just disagree on these amounts. Okay, and she also is going to try to understand kind of what the impacts of this are. I think I sort of went through all this. So she argues that basically, what happens if I shock this firm over here? Well, if I was and I sort of make sure this firm kind of becomes honest, well, in collusive evasion, right, all of a sudden, that whole transaction sort of appears on the books. Yeah, so, okay, so what happens basically in collusive evasion, when I shock this firm, that new thing kind of, that new that new thing goes up, and this firm can actually start reporting it as an input, and maybe reduce their VAT. Over here, what happens is kind of they all have to kind of move towards like agreement, and so those could be sort of two different kind of effects. What I want to talk about a little more though is what she actually does in terms of the experiments. So she does two different things. The first thing she does is she does a spillover experiment, which is to say she tells these firms that they're going to be firms that are suspected of tax evasion. They're told they're going to sort of they're going to be audited. They then go and audit them, and they sort of see what kind of happened, what actually happened. And the thing I want to note here is this audit is kind of the thing required to actually kind of go and sort of match everything up. So she only knows what happens to the upstream and the downstream people in the kind of the audit group, because sort of doing that whole matching actually kind of is manual and requires kind of the audit to actually take place. Okay. In the deterrence experiment, she basically sends some random fraction of people in different parts of the chain a letter saying you're likely to be audited, and looks at kind of their responsiveness. Okay? So these experiments are sort of doing two different things. And one thing, so this one I think is pretty clear, right? This is basically testing kind of for the VAT chain. This one I think has the cleanest test. This one basically says, if this VAT chain thing is actually happening, and I tell you all of a sudden you're going to be audited, the question is not just what your response is, but does that sort of feed through to kind of your upstream and sort of downstream people kind of through this VAT chain. The second piece, the deterrence piece, is a little less clear, I think. In the deterrence piece, she basically says, look, where in the VAT world in general, where should sort of evasion be highest? Right? We think evasion should be highest kind of down here at the retail level. So if you believe that sort of what's happening in the deterrence experiment is that it moves you from sort of whatever you were doing now to kind of like no cheating, then you expect a larger responsiveness down here because there was more cheating to begin with. But I think, as one of you pointed out in your comments, this one is a little more complicated because you could also have the view of like maybe the audit can't figure anything out down here because there's no kind of like way of figuring out what the truth is over here. So I think this one, the deterrence one, is only interpretable if you think of the deterrence as kind of moving from like whatever you were doing before to kind of like the truth. Then I think her interpretation of sort of using that to measure sort of differential amounts of pre-cheating is right. If you sort of say, well, it's not clear kind of what we're learning from the audit unless like because that is related to kind of where you are in the VAT chain, it's a little bit less clear. Does that point? It's like a little. She's trying to infer something about the level from which she measures as a derivative, right? She measures sort of like what is D taxes, D audit, okay, for the three different places. She's trying to infer something about the level of pre-period evasion from that derivative. And I guess the point I'm making is that only is valid if you basically assume that kind of the shock is kind of like getting you to the same point in all those places. And I think that's not totally obvious. So that's why I like the spillover one better. I think spillover one's cleaner. Questions about the experimental design? Okay. So what does she find? Oops. She finds, this is the spillover stuff. So this says, so like, you know, do you pay more VAT? You know, if you're going to be audited, right, then yes, you do. Okay. That just says that's the own effect. And the question is sort of like, are there sort of like upstream or downstream effects? And the answer is there are pretty strong upstream effects. Okay, so what this basically says is I audit these people over here, right, and these people also pay more taxes. Okay, and that's it. And I think that's kind of the key point. You know, why might the retail people not pay more taxes? Well, because they kind of have a lot more flexibility sort of at the bottom end. right? So people who are sort of downstream, they can sort of adjust, kind of, in the sort of the three-chain version. In the real world, it's more complicated, but certainly the more downstream you are, the retail people are the ones that have sort of the most ability to sort of to evade things. So that's kind of the key point over here, is that it seems to sort of spill over upstream. And I think that's sort of the best evidence that we have that actually these chains seem to be mattering. In the deterrence paper, this is too small, sorry, so let me sort of zoom in on it, since you don't have the handout. The key point here is just a heterogeneous treatment effect. So where does the deterrence effect have the largest effects? It is the largest effects for the people who are more downstream. Okay, so that basically is arguing that sort of there was more cheating kind of happening, kind of under the assumption that you can learn about the level from the derivative that I talked about before. She's sort of arguing there's sort of more cheating kind of down there. Okay. That's kind of what I wanted to say about this paper, but you guys, do you have any comments or questions from having read it? Kailash, you look like you have formulated a question.
I just want you guys to go over whether the deterrence experiment, do you think that was designed with this question in mind, or do you think it was like they learned something and then it was like, maybe we should test the spillovers?
Oh, did they go into this like
with that testing, with this theory in mind?
I mean, I can't speak to what she was thinking when she designed the experiment, but I suspect they did. I mean, I think this is the key question in VAT, is that those people were trying to understand, was sort of understanding the spillover. So I think that I think they were trying to go into it with the two things. I think the reason for the two experiments is the deterrence experiment. She can measure the outcomes. She doesn't need to know who the suppliers and the clients are. You see what I'm saying? Like, so the advantage of the deterrence experiment is you get this enormous sample, and you don't need to know the whole VAT chain. So I think there she can try to say, well, look, I'm trying to understand something in a really big sample. Like, what can I possibly learn? And she doesn't know who the suppliers and the clients are. The reason for the audit experiment and why she has to do that in a smaller sample is she only can learn who the suppliers and the clients are once they do that manual kind of audit process, because at least in this context it's not sufficiently automated. So if you had a fully automated system, you could run the spillovers in this experiment too, but she can't do that because they don't have that data.
So that the deterrence thing is just adding this kind of scale and external validity.
Yeah, I think it's adding a different piece. Under the assumption that I was saying before, that you can learn something about the pre-period level from the derivative, it is testing a different aspect of this question also, which is to say, look, there's two questions you might believe. One is you'd say, two questions about the VAT from the simple theory. One says, look, this thing spills over. The other says there should be way more cheating at the very bottom, at the very downstream. And so she's sort of arguing that by learning about this derivative, you're learning that maybe there is much more cheating there. It's certainly consistent with that idea. Other questions? Yeah, Amit.
Sending returns to letters is quite cheap, right? It does feel like there's a simple way of increasing government tax revenue, or does it?
Well, the question is sort of what is you can't deter people. You have to have rational expectations. You ultimately have to deal with rational expectations. So you can't tell everyone they're going to be audited with 100% probability, not audit everyone with 100% probability, because eventually they'll figure it out.
But for the short term, it's free money.
But in the long run, it has a lot of, in the long, I think it has credit. I think that, and I think this was worded in a way to be honest and truthful. But I think that you have to, and that suggests that's true. But it's not like a free money machine. I think you probably have to actually increase the audit rate too, ultimately. But there is this basic fact that governments are sort of like, many governments are not spending enough resources on enforcement, which I will argue in the next paper, which I'll probably teach at the beginning of the next class, at least in Indonesia, and is actually a very active debate in the U.S. like right now. Is like, should we spend more money on tax enforcement? And there's many estimates sort of conclude that governments are not spending nearly enough money on tax enforcement. That it's like a very, very high return activity. Yeah.
In the case where supplier and buyer like bargaining over the tax, why do we expect them to, for the solution to the bargaining game to be like the true amount, like the correct amount versus just like some solution to some bargaining? I don't know.
Well, the tax authority doesn't care.
Oh, why is that?
Well, imagine I move this line over here. As long as they agree, the government's still getting taxed on this whole amount.
So the problem is that,
As long as they agree on what they're going to report, you should, that's the beauty of the VAT. Is like if we report if we say like for everyone except the bottom layer, like if we in the sort of the my sales to you are how much what I sell to you is how much you buy from me. So if I say I'm selling to you at a lower price, I pay less tax, but you pay more tax because your inputs go down. So at some level, the government doesn't care. You see what I'm saying?
It would matter for like firm size stuff, right?
Yes, it might have implications for the economy. I think also, I think maybe for the deterrence reasons, maybe for the denouncement reasons we talked about before, that sort of there's a focal point on the truth. But I think it is an interesting question, actually. There may be some. I suspect there's some good micro-theory bargaining answer that I don't know the answer to for why that might be true, but I don't know it off the top of my head. Yeah.
Is there any literature related to this kind of systems to organized crime and
So what? Sorry.
To organized crime and like money laundering?
Tell me more.
So the general idea is that maybe if you're organized crime, you like use like small retail stores to like just launder money through there, and then if you kind of set up a system where you have like double reporting, like this one,
It would make it harder.
it'll make it harder to make
Yeah. So sorry. So why is money laundering relevant here? So money laundering is almost the inverse problem, right? It's the money laundering problem is the inverse problem. I have a bunch of cash that's illegal that I would like to make look legal. That I want to sort of like make look legal. And so the way that they do that is you basically you have a business that has a lot of where the actual income level is not reportable, and you overstate your income essentially. So this is the you buy a cash business. The money launderer runs a cash business and overstates the amount of actual kind of business going through as a way of sort of mixing the kind of the cash they want to make legal with the sort of the legal cash. And because the government can't observe kind of the retail side, you can just you can overdo it. That's that's the idea of money laundering. It's the inverse problem of this. It's like people want to pay more taxes, right? So yes, there could be implications to that. I haven't thought them through. I think as long as that's why the money laundering guys work at the retail level, because you can sort of that's where it's that same point that kind of the government really doesn't know what's kind of happening at that very last piece. And that actually leads me to the very last thing I want to say on this topic. Actually, no, sorry. There's two things I want to say on this topic. Number one is one cool thing about the VAT is that, in principle, governments are collecting huge amounts of data on who's trading with who, at least in the formal network. And I think a bunch of researchers have realized this, and that this is like a cool data set on, very hard to obtain because it's like tax data, but a cool data set in principle on like the whole network of supply chain relationships. And I think Dave Donaldson and Dina Pomerantz and several co-authors have actually a paper kind of using this kind of data, as do I think a few other people. So it's an exciting area that people are starting to think through. And the second thing I wanted to mention is, the last thing I would say is, well, what can you do at the very end of the chain? And so Joanna Naratomi has a paper on this, which basically says, can we find a way to incentivize people at the very bottom of the chain to be honest? And I'll just note, if you've ever been to a store where it says, if we don't give you a receipt, your purchase is free, like, what are they doing there? Why are they doing that? It's the same idea. They're trying to incentivize the consumer to make sure that the transaction is reported through kind of the cash machine, right? In that case, it's about usually it's about the employer worrying about sort of the clerk stealing kind of the resources, which is why they want it to be reported. But the same idea is like, how can we incentivize the sort of the very retail consumer to sort of make sure things are properly reported? And so she studies a policy in Brazil where they gave out the VAT receipt issued at the final thing was also a lottery ticket. Okay, so for every dollar of actual legally reported VAT, you get to enter some lottery and the government gives you prizes. Okay, and like it's very small. So the value is 2% of the total purchase price. So you know that's I don't know what the VAT rate in Brazil is, but let's say it was 10%. You know, it's still, you know, even if the retail sector is, I don't know, 30%, it's still like a small share of kind of the total VAT the government is collecting, even in this last piece. But it's at least some reason that if you're like at least totally indifferent, you shouldn't be totally indifferent. And she finds that actually this leads to a huge impact of like a 24% impact in sort of reported revenues from the sort of the very bottom firms. And so that suggests that maybe there's something you can do to kind of incentivize people down here as well. Okay, I'm out of time. I'll stop here. I'm gonna finish up by talking about tax administration next time.